By the second quarter of 2026, the global financial system hit a hard wall. We are now watching the collapse of the unipolar financial world, replaced by a system anchored in physical materials. The foundational security of United States treasuries, the baseline of global trust, has fractured. This chart shows the specific data anomaly crossed in early 2026. The rising curve tracking United States debt interest payments has now sharply intersected and surpassed the total national defense budget. Crossing this fiscal threshold triggered an immediate crisis of confidence among the major foreign sovereign entities holding U.S. debt. The global market is actively repricing U.S. treasuries. They are no longer treated as the ultimate safe haven asset, but as a compounding systemic liability. In response, a coalition of resource-rich nations operationalized an alternative financial platform at the 2026 expanded BRICS Plus Summit. This operates on distributed ledger technology, not fiat currency. Trade settles using a digital unit tied directly to physical oil, gas, gold, and wheat. Saudi Arabia's 2026 policy to accept multiple currencies for oil effectively ended the petrodollar era. By tying settlement value directly to raw materials, this ledger circumvents the United States banking system and permanently cuts out the global middleman. The primary Western countermeasure, the digital dollar, or CBDC, is actively failing its global adoption trials. These trials created a privacy paradox. Smaller nations are refusing adoption, calculating that a digital currency controlled by the West will be used as a financial weapon through aggressive sanctions, operating even more efficiently than the current system. This rejection is fracturing global commerce into massive bilateral barter networks. India trades tech and medicine for Russian oil using local currency, while China trades infrastructure for African minerals using the digital yuan. Central banks across the global south are purchasing physical gold at volumes unseen since the 1960s, draining wealth from digital IOUs directly into physical vaults. Control over the global economy has definitively shifted away from the nations that print digital currency and toward the nations that hold physical resources. The rapid global abandonment of the dollar is stripping systemic liquidity from the market, causing borrowing costs to violently spike worldwide. 2026 is the final year of structural positioning before the fiscal consequences hit the broader market. By 2027, the fracture will trigger the great default for nations caught in the middle, requiring immediate defensive capital preparation today.